Hello and welcome to Macro Sutra, our very new show on macroeconomics, the political economy, and policy. The economy is generally never out of the headlines, but this week it is more so because it is the week before the general budget. And then there are big global headlines: the US Fed Reserve decision, crashing stock markets, oil prices due to tensions in the Middle East, war clouds in Europe. It's actually a action-packed week for the economy. And who better to launch this show for us than Sonal Varma, who's the Managing Director and Chief Economist at Nomura, one of the world's leading financial services firms. Sonal is one of India's most accomplished economists, although she's now based in sunny Singapore. She analyzes key economic trends in the region, writes very detailed reports, and manages a team of regional economists. Among other things, she was a member of the Indian government group of experts that put together the Index of Industrial Production, or IIP, as you see in the headlines. It's the privilege of ThePrint that Sonal has agreed to do this conversation, and hopefully on a regular basis, and my pleasure to host and interact with her. Welcome, Sonal. It is such a pleasure.
Thanks a lot, YP. Pleasure to be here.
Sonal, can we begin by talking about where the economy, and particularly the Indian economy, finds itself at the beginning of a new calendar year? Omicron has hit the recovery that had begun after the second wave. The global situation, like I just mentioned, is just getting complex and complicated. There are too many headwinds, as economists would call it. And the NIBRI, or the Nomura India Business Resumption Index, has fallen to 100.5 for the week ended January 23. That's just last weekend, which means the third wave has dragged business resumption back to pre-pandemic levels. A bit gloomy, shall we say?
YP, I thought we should begin the conversation on a more optimistic note, but you've, asked a lot of questions in there. So let me split it into three key parts. One is, where the economy was prior to the third wave. Two is, what's going on after the third wave. And three, you mentioned a lot of the global developments. Now, where were we prior to the third wave? Essentially, an economy which is recovering from the pandemic lows, but where the recovery continues to be quite uneven. I do want us to take a step back, and the period prior to the pandemic. India was in a slowing growth environment during the course of 2019 and early 2020 when the pandemic hit. So from there, of course, despite the second wave hit, growth has recovered, but the recovery is quite uneven. What we've essentially seen is a big bifurcation, I should say, between different segments. So, for instance, the consumption that is more geared towards rural and poorer segments isn't doing that well. In fact, that stagnated, whereas the demand from SUVs, etc., is doing extremely well. The goods side of the economy, which is more manufacturing and export driven, has done very well because global growth is quite strong. But services, for fairly obvious reasons, which is, these are more contact intensive, they're trying to normalize, but they keep getting hit. So it's a big bifurcation. In fact, we see this bifurcation even, from a markets funding standpoint. Over the last 2 years, we've seen a lot of monetary easing, for instance, a lot of liquidity that the RBI has injected in the markets. Everybody has benefited, but it's the bigger firms that have benefited a lot more, the smaller guys who have been impacted. So, as a lot of people have been discussing in terms of it being a K-shaped recovery, I would say it still remains very much a K-shaped recovery. The second aspect is, the third wave and the Omicron impact. I think one encouraging sign really from, countries that have seen Omicron-driven waves, whether it's South Africa, UK, parts of US now. Essentially, the good news is that it's sharp wave in terms of acceleration, but it tends to be shorter in duration and milder, so the hospitalization is less. So the economy is learning to live with the virus. Consumers and businesses are learning to live with the virus. All of us are doing a lot more of online shopping now. But the reality is that when infections go up, people do tend to become a bit more cautious. So the starting point essentially was an uneven recovery. Here comes the third wave. We've seen further unevenness. So the same contact intensive services that had not fully normalized have again been impacted. What you were referring to, the NIBRI, the Nomura India Business Resumption Index, it's essentially, a mix of high frequency data to assess on a weekly basis how fast the economy is normalizing. So in Q1 2020, we've sort of indexed this at around 100. So we were essentially around 120 in end of December. We've fallen back to about 100. So there's been a 20 percentage points fall because of the third wave. This is actually much better than the second wave, where we had fallen nearly 40 percentage points, and the first wave where we had fallen almost 55 percentage points. So it's a smaller hit, but there's a hit. So we do think there'll be some growth impact. The third aspect is, you mentioned the global backdrop, and I think the global backdrop is surely becoming a bit more maybe hostile. The Federal Reserve is about to embark not just on interest rate hikes, but also quantitative tightening. So essentially, the huge increase in balance sheets that we have seen is going to be unwound in the coming quarters. This typically does have an impact on money that flows into countries, emerging economies. When there is easy liquidity, we do tend to get a lot more money. So the global financial conditions are turning more adverse. And the geopolitical developments and the fact that there hasn't been enough investment on fossil fuel capex is, a combination of factors that are basically leading to higher energy prices. So I think that's sort of the background we are in. I think the key question as we look forward in this backdrop is the third wave impact should be lesser. But, how durable is the growth recovery going to be, from a 6 to 12 to an 18-month perspective, given it is uneven domestically and given the global conditions are a bit more adverse? That's the fundamental question.
Sonal, can you tell us a little more about the Nomura India Business Resumption Index, or NIBRI, as we mentioned. I find it a very fascinating new, way of trying to estimate how business resumption is progressing. Could you just explain it for the benefit of our viewers who may not know how NIBRI works?
Sure. So, most economic data tend to be monthly, and typically, you want to have a more high frequency assessment of how the economy is doing. So that's what we're trying to do, a more high frequency assessment of how the economy is progressing. So for our index, we've basically included, 4 key variables to assess how the economy is moving. We have, mobility data. So, Google actually comes out with detailed mobility data on, whether people are stepping into, malls for recreation, are they going to their workplace to work? So there's a way to capture this. We also, of course, have the Apple driving index to assess whether people are, driving about. So These are important indicators, for instance, essentially to assess from a consumption and services standpoint whether people are sort of going out there and spending or not. So we've taken some of these mobility indicators into account. So outside of these mobility indicators, there are a couple of other indicators that we have included in our business resumption index. One is the labor force participation rate, essentially to assess whether people who are in the workforce are actually getting gainfully employed or not. Because one thing that we have seen post-pandemic across a number of regions is that the participation is actually much lower than it was prior to when the pandemic began. So this indicator is, of course, important because ultimately, if you want growth in any country to sustain, you want jobs to be created. So that's what we're trying to assess here. And a final indicator we've used is essentially weekly power demand. Power, of course, goes across various manufacturing and services units. So we're trying to assess whether power demand's picking up or not on a weekly basis. So essentially what we've done is through a mix of labor market indicators, power demand, which is capturing how the real economy is doing, and mobility indicators, which sort of captures how the consumption and the services side of the economy is doing, is try to build a more high frequency indicator on the impact, how the economy is progressing, or how the third wave may be impacting the economy.
Wonderful. So that brings us to the general budget that is due to be presented next Tuesday, that is the 1st of February, by Finance Minister Nirmala Sitharaman. Budgets, I mean, if you live in India and especially you're in the media, it's a very huge event, and they're special every year. But this year, more so for more than one reason, or all the reasons we've mentioned so far. The finance minister has to keep in mind the need to push recovery, the need to take care of vulnerable sections of the population, generate revenue, and very critical assembly elections. So how much does this budget matter overall, according to you, Sonal, or is this just an event all of us hype so much because in the past people have said that budget is just an accounting exercise? Why do you guys get so excited?
Yeah, I think a lot of the policy moves really happen outside the budget. So I would say it's more evolutionary than revolutionary in terms of what we should expect. Now, I mean, you're right in terms of the various macro aspects that the government has to manage. There is, I mean, even if you keep the elections out, the reality is that if the growth recovery is uneven, that has also economic and perhaps political implications. So there are, these various things that they are trying to balance. I think, first of all, we're all hoping that sometime this year we move from, the pandemic to an endemic kind of a situation. But we are still in the midst of the pandemic. And I think one thing that the budget, has to address, therefore, is the impact that some of the segments are facing because of the pandemic. So, for instance, the small and the MSME sector, the credit guarantee support that was given to these segments, is something that can be extended because they continue to be suffer. Similarly, credit support to the contact intensive services sectors, hotel, hospitality, the entire travel and tourism sector is something that needs to continue. Second, I would say the broader welfare spending is something that the budget still needs to take into account. So the allocations under the rural employment guarantee scheme, because we still need to provide that support to rural households. There's still a lot of demand for work generated under the Magnarega scheme. So more allocations will be necessary there. There's a lot of healthcare spending we still need to do on vaccinations and boosters, for which money needs to be allocated. Outside of this, I would say one thing that we've sort of learned during the pandemic is that we don't have a good social security net for the urban poor, segment. So while we had the system set up for rural employment schemes, for instance, we didn't have something similar for the urban poor, let's say the migrant workers. So some sort of a social security scheme for urban poor, in cases of emergencies like this is an infrastructure that we need to essentially have. Then, of course, is the need to push on growth. So, you have the here and now challenge of the pandemic-related, welfare-related spending. But then you also need to today focus on how do I ensure that tomorrow's growth is more durable. And there are multiple pillars under this. You need to create new demand drivers. This demand driver can be the export segment, which is where this entire production-linked incentive scheme comes into play. The national infrastructure pipeline, the allocations there. So, we need to, of course, spend a lot on these programs as well. And the final challenge, in this is, how do we balance all of this? And one strategy which I think, we've adopted over the last many years, which I think should continue, is this asset, recycling mechanism, asset monetization for, projects going forward, or disinvestment and privatization, because we need to create new infrastructure. So I think there are a lot of asks in front of the budget. But broadly, those are the various things I think, the budget should be looking at.
The Nomura budget preview talks about growth versus fiscal prudence as one of the key focus areas. But now we just talked about all the pandemic support issues, also which you have mentioned in the preview. So there is growth versus fiscal prudence versus pandemic support. Do you think a balance is possible at all, Sonal?
It's tough, but I think, we will have to balance. We cannot afford to ignore growth. So I think one thing that we have learned over the years is that fiscal consolidation in India is extremely difficult in the absence of growth. So it's really growth that helps us in fiscal consolidation. So I do think that we cannot ignore growth, and both in terms of the current support on welfare schemes and future support for capex, both need to come through. Now, what we're trying to get out of this is essentially the capex and export incentive support. The hope here is that triggers faster growth. And the faster growth in turn leads to even more capex that creates more jobs. More jobs means more income, means more consumption, means more demand, means more capex. So that's sort of the virtuous cycle we are trying to essentially get. And we cannot do fiscal consolidation at the expense of growth. At the same time, we cannot say we don't care. Because the global backdrop, as we were discussing earlier, is shifting. And typically when, global central banks start to reverse their monetary policies, there tends to be a greater scrutiny on emerging markets. And India does stand out as, one with higher levels of fiscal deficit and public debt to GDP ratio. So, that balance needs to be there. Now, the question is, how do you balance this impossible balance? One, of course, is, you rely more on disinvestment and asset monetization to fund this. So that's one way out. Second, I would say that maybe we need to be smart in terms of, what we want to tax. So if there are, objectives such as the green initiatives, then, more taxes on, carbon emitting segments is something that we can look at as a means of higher revenue. The third, I would say, is on the expenditure rationalization side. So we spend a lot. But it's not easy to spend, and sometimes a lot of money is allocated to schemes. There's a lot of double counting. Departments sit on cash. It's not spent. So there is a lot of streamlining and rationalization on the expenditure side that can be done. We can look at merging different, schemes, for instance. The usage of the direct benefit transfer, the DBT, has been a big boon in terms of cutting leakages. So we can, for instance, expand the DBT scheme to essentially use that across a number of other schemes going forward. So there are ways, to balance this, I would say.
Last two questions, Sonal. After the budget in the first week of February, the RBI monetary policy is due. Are you expecting any surprises, or is there even room for any surprise?
Well, I think the monetary policy outlook to an extent may depend on what we get in the budget. But there are a couple of things actually. One, if you just take a step back and what kind of policies does an economy need where the recovery is uneven? I think the role of monetary policy is essentially gradually diminishing because the adverse impact, and as we call, the scarring effect, the long-term scars, are mainly felt in sectors where the benefit from loose monetary policies is really not much. What they need is more sort of targeted fiscal support. While keeping monetary policies too loose, while cost is rising, inflation is rising, is actually a double whammy for the economy. Because the lower income households are impacted on the income side. And if inflation goes up, the real purchasing power of the money that they have actually goes down. And I think that's, in fact, one of the reasons why demand on the mass consumption side has been weak. So essentially, there's a role for more targeted fiscal policy going forward and for monetary policy, given signs of rising inflationary pressures, to essentially start unwinding the ultra-accommodative monetary policy. Now, I don't know what they'll do in February, but if you broadly look out over the next 6 to 12 months, the exit from ultra-accommodative monetary policy, is going to take shape in various ways. First is on the liquidity side. Today, the total system liquidity is close to 10 lakh crore.
Yeah.
So, it's a substantial surplus that we will need to gradually unwind. There are various ways to do that, but we need to gradually unwind this excess liquidity because it's really not helping in growth, anymore. The second is in terms of more the policy instruments. RBI has a policy corridor, the reverse repo rate, which right now is extremely low at 3.35%. So, that needs to be lifted, and then the policy rates itself will move up. So broadly, the direction going forward is for a reversal on the monetary policy side, both on the liquidity side, which is sort of more imminent, and broadly on the policy rate side beyond that as well.
Last question, and it's not an easy one, but you can try. What would you do, or what would be on top of your agenda if you were in Nirmala Sitharaman's shoes?
Lots and lots, but in terms of the key things, I think first is really tax simplification. I mean, I know, we are aiming to move in the direction of lower tax rates and lesser exemptions. And we are getting there, but I think still a lot needs to be done in terms of simple tax simplification. I do think that that will end up helping the economy in terms of more revenue collections if we simplify. So, compliance should not be more costly than non-compliance. Second, I would definitely continue on the infrastructure side. I mean, that's a clear low-hanging fruit. As you would have heard, a lot of other economists say it basically helps both on the demand side and the supply side. You're creating future infrastructure. You're helping boost India's potential, and you're creating jobs, which will help in consumption demand. And I think, most of the other stuff that we are trying to achieve, including production-linked incentive scheme, export competitiveness, it's not going to come purely through incentives. What happens after the incentive expires? You've got to be competitive. And what is the definition of competitiveness? It includes many things and, a lot of regulatory stuff as well, but also the infrastructure side. So that will definitely be a big focus. I think we are very fortunate to have this opportunity, and we should, continue to leverage on this. Finally, this is not necessarily budget specific, but I think from a medium-term perspective, the investment in more soft infrastructure is also important. The pandemic has essentially made us realize the importance on the health side. I think the education side, skill creation, better quality primary schooling, secondary schooling, tomorrow's competition with world economies is not just going to be on labor, but the quality of labor that we produce. So I think we need to start investing now.
Thank you so much, Sonal. That was a very simple yet insightful take on the economy and budget preview. Let us hope the budget lives up to its expectations, or at least not disappoint us. It was such a pleasure listening to you, and we hope you will be back with us very soon with ThePrint to share your thoughts. Stay safe and goodbye for now, Sonal. Thank you very much.
Thank you very much.